When looking at any property market, most conversations revolve around entry. People talked about the right market, the best community, the ideal exit type, or future growth. But beneath all the noise, the fundamental question is much simpler. Can you get your money back? When investors first approach the UAE market, the questions are usually very similar. Should I buy in Dubai, Abu Dhabi, or Ras Al Khaimah? Should I buy an apartment, a villa, or an off-plan project, or something already completed? They are reasonable questions, but they are not the last questions because every investment eventually reaches the day you need to sell. And when that day arrives, the quality of your exit can matter as much as the quality of your entry, which brings us to a concept many investors overlook until they actually need it: liquidity. Investors often treat values and liquidity as if they are the same thing. They are not. A property can increase in value and still be difficult to sell. A property can generate strong rental income and still have a limited buyer pool. And a property can look very successful on paper while creating challenges when capital is actually needed. Value answers one question: what is it worth? Liquidity answers another: what can you do with it? Most investors think liquidity means selling quickly. I see it differently. Liquidity is really about having choices: the choice to sell, the choice to rent, the choice to refinance, or simply the choice to wait. When liquidity exists, you decide. When liquidity disappears, the market decides for you. That's why liquidity is not really about speed. It is about control. And the more choices an investment preserve, the more resilient it becomes. If liquidity is about preserving choices, why does it matter so much? Because investors rarely worry about liquidity until they actually need it. When markets are rising, most people focus on growth, return, yield, future potential. But what happens if you need to sell now? Not when market conditions are ideal, but when you need access to your capital. At that moment, liquidity is no longer a theory, it becomes a practical question. Are you choosing the timing, or is the market choosing it for you? This is why experienced investors spend as much time thinking about the exit as they do the entry, because buying starts the investment. Liquidity helps determine how much flexibility remains when life does not follow the original plan. So, what actually creates liquidity? Why are some markets easier to exit than others? In my experience, liquidity usually comes from four drivers: people, jobs, capital, and transactions. And more people create more buyers, more jobs create more demand, more capital increases purchasing power, and more transactions create confidence. Liquidity is not a fixed feature of a market. It reflects how these four drivers are performing at any given time. When they're working together, liquidity feels abundant. When they're not, selling becomes much harder. Now, let's apply the framework to the UAE. The UAE is not one property market. It is several markets with very different levels of liquidity. If you need to sell within the next 90 days, how many qualified buyers exist for your exits? This chart offers one way to think about that questions, not through price, not through yield, but through the depth of the buyer pool. The answer is very different across the Emirates. Dubai sits at one end of the spectrum. The North of the Emirates sits at the other. It is not about which market is better. It is about how many exit options may exist when you need them. Because liquidity is not a measure of quality, it is a measure of flexibility. Most investors focus on the entry. Experienced investors think about the exit. When you are seeing here is not just market growth, it's market depth. Liquidity is not created when you decided to sell. It is built over years. When the time comes to exit, investors are not looking for the perfect market. They are looking for the next buyer. And the deeper the buyer pool, the more options exist. Buy for the growth, but invest with the exit in mind. REC has a credible growth story. The tourism foundation is real, and upcoming developments may accelerate international demand. But future potential does not create liquidity today. The secondary market exists, it is just not yet as deep as a mature market like Dubai. Buying here is not a mistake, it is a trade off. Dubai offers liquidity today, REC offers potential tomorrow. Neither strategy is wrong. Just make sure your exit timeline matches the reality, not the expectation. Abu Dhabi represents a different kind of liquidity. Dubai's strength is volume, Abu Dhabi's strength is retention. While it generates fewer transactions, it relies far less on speculative turnover. That does not mean it lacks growth. In recent years, capital appreciation in many parts of Abu Dhabi has been significant, but the underlying source of its liquidity is fundamentally different. Its foundation is end-user permanence. People are not only buying assets here, they're building lives. Dubai offers liquidity through scale. Abu Dhabi offers liquidity through permanence. And permanence can be a powerful foundation for long-term value. Emirates selection is only your first decision. Exit selections is where exits are won or lost. What you're seeing here are the five invisible forces that influence exit flexibility, because two properties in the same city with the same budget can have completely different exit outcome. Liquidity is not just a citywide statistics. It drills down into the community, the property type, the price point, and who your next buyer is likely to be. A broad exit profile creates more exit options. A highly specific access narrows them. Before you look at a single payment plan, ask yourself five questions. Which market? Which community, which exit type, which price point, and ultimately, who's likely to buy this from me later? The city creates the opportunity, the access determines the exits. Two investors can buy in the same city at the same time with a similar budget and still experience completely different exits. Why? Because exits do not exist in a vacuum. They exist within communities, and community exists within wider ecosystems. A mature ecosystem already has the infrastructure, the employment, and the transaction depth to support demand today. An emerging ecosystem may offer significantly upside, but much of that demand still belongs to the future. Liquidity is fundamentally a demand story, and demand tracks where people are already living, working, and building lives. You aren't just buying a property, you are buying the surrounding ecosystem. Sometimes the community is the investments. Many properties discussions focus entirely on flipping. The operational reality is completely different. Look at the data. Nearly half of the investors who bought over a decade ago still own their assets today. Even for those who entered just 3 years ago, over 60% are still holding. Property often becomes a long-term investment, even when it wasn't meant to be. Sometimes that holding period is by choice, but sometimes it's because the next buyer simply isn't there yet. A resilient investment must work even if your exit takes years longer than expected, because liquidity is most valuable when reality fails to follow the plan. The true test of liquidity rarely happens when the market is booming. In strong markets, buyers are active, credit is available, and exiting an asset feels easy. Between 2020 and 2025, Dubai experienced five consecutive record years. In environments like that, liquidity is often taken for granted. But when markets slow, the equation changes. Supply increases, buyer activity drops, and competition rises. That is where liquidity matters most. Because when a market shifts, liquidity always weakens first. Price often follow. It is not a prediction of a corrections. It is an operational reminder. The real test of an investment isn't how it performs when buyers are plentiful. It is how it performs when buyers become selective. Bull markets high liquidity risk. Slow markets revealed it. Most investors spend a great deal of time calculating the cost of buying. Very few calculate the cost of being unable to sell. When an exit takes longer than expected, the bills do not stop. Cost continues to accumulate. The capital remains locked away. But the financial cost is only part of the story. Life does not pause for the market. People relocate, business needs change, and family circumstances evolve. An illiquid exit will not adjust to your timeline. More often, you are forced to adjust to it. Liquidity is not a nice to have, it's risk management, because the true cost of an investment is not what you pay to enter, it is what you pay while waiting to exit. No investment is risk-free. Markets slow down, prices adjust, and buyers become highly selective. When that happens, you have to ask, what happens next? The unique advantage of real estate is that an asset you cannot sell is not automatically a failed investment. It simply means you move to your next options. You can generate income, letting strong rental yields carry the property. You can hold through the cycle, giving the market time to recover. You can refinance, accessing cash from your equity without selling, or you can simply wait for the demand to return. Real estate becomes incredibly fragile when a fund's exit is your only strategy. Liquidity is not just about cashing out, it is about creating options. Plan for the exit you want, build a portfolio that can survive the exit you do not get. Most investment discussions begin with upside, future growth, capital appreciation, entry opportunities. There's nothing wrong with those questions, but they are only half the equation. The other half is this: who will buy this from me later? Because buying is usually the easy part. The quality of an exit often matters just as much as the quality of an entry. Many investors spend months researching how to enter a market. Far fewer spend the same amount of time thinking about how they might leave it. The ultimate question is not how much can be made, it is what options remains if plans change. Buying starts the investments. Optionality protects it. When looking at any property market, most conversations revolve around entry. But beneath all the noise, the fundamental question is simple. Can you get your money back? It is not about whether a market will rise forever. It is about how many options remain when reality turns out differently. The strongest investors are not always the ones who predict best. They are the ones who preserve the most flexibility. Property is the exit, optionality is the strategy. This episode asks, can you get your money back? Next episode asks, is your money working hard enough while you hold? Because return is not only about future growth, it is also about what your exit earns along the way. Next time, yield arbitrates.